All right, welcome to On the Tape, the Monday edition. I'm Dan Nathan. I'm joined by Guy Adami and EY from SoFi. That would be Liz Young. She's the head market strategist over there at SoFi. Gents and lady, this morning, usually we like to have a little fun on a Monday morning, and it's just kind of one of those days, right? Guy, you've been saying this for a long time. You've been doing Fast Money on CNBC for almost 17 years. I've been doing it for 13, 14 years, and every once in a while, we have to kind of think about markets through a slightly different lens, ones that I don't think any of us are really charged with doing, and sometimes it feels almost inappropriate when you think about this, war that's going on in Israel and the loss of life and probably what's likely to happen, for weeks, if not months to come on a humanitarian level. So again, our hearts go out to everybody involved in that situation. But we got to talk about what we're here to talk about a little bit. And when you think about just some of the impact that we've seen on commodities, on growth globally, it was massively impacted by the Russian invasion of Ukraine in the beginning of 2022. So we're, a little steeped in that. So we're going to get to all that. We're going to get to some earnings this week. We're going to get to some economic data. Also, just a little housekeeping. Guy and I had a great conversation last week with Chris Miller. He is the author of a book called Chip Wars. And this is a really interesting one. This was first, Guy, I think Mike Mobison, your good friend, I think he referenced this book to us, recommended it to us and to our listeners late last year. And it's a book about the history of the semiconductor industry going back to the 40s and really talking about just the kind of race that we were in to develop the semiconductor for a whole host of reasons. Obviously, many were from a military standpoint before all the consumer applications were known, and the race that we had with Russia, and then obviously with China and everything that's going on now. This is a great book. I'm actually almost done with it, so I recommend it to people. And if you want a copy of the book, the first 100 listeners who go to the podcast store, you find OK Computer. It's OKAY Computer podcast. Leave a review for that. We're going to put the full interview on that feed. That is a fine podcast that I host with many good tech folks there. Leave a review, send it to contact@riskreversal.com, and you will get a free copy of Chris Miller's Chip War. Okay, Guy, let's talk about this a little bit. And Liz, listen, there's lots of implications. Just foremost, I'll just say that the potential for wavering support for Ukraine, and obviously what President Biden said over the weekend in our unwavering support for Israel, and what that means from just an aid standpoint. Might it be diverted, some of which to Israel to deal with this? Obviously, our administration was involved in this. They're trying to reset normalization of contact between Saudi Arabia and Israel. What does that mean? What does it mean? The Wall Street Journal over the weekend was reporting that Iran was possibly helping to coordinate this Hamas attack. What does it mean with Iran? What does it mean, Guy, for the Chinese and embolden them possibly with the situation with Taiwan that we've been talking about? So all of a sudden, there's lots of geopolitical hotspots. Talk to us a little bit about this, because we have the futures down as we're talking right now, maybe 70 basis points. We have crude up 3%. We have the dollar up 0.5%. We have gold up 1%, that sort of thing. So through the lens that we're charged at looking through, there's a lot going on, Guy.
No, that's exactly right. And through our lens, there is a lot going on. And you actually touched on all the salient points. What does it embolden Russia in terms of what's going on with Ukraine, thinking that somehow some of the funds that would have gone to Ukraine are going to be diverted? I have no idea, but obviously that's part of the calculus. And does it embolden the Chinese to potentially do something, understanding that now, the world is seemingly has wars, for lack of a better word. I mean, I think that's the correct word, on multiple fronts. And what does it mean to the commodity world? And through our lens, more importantly, what does it mean for the bond market? Is this going to be the catalyst that creates this flight to quality that we've been talking about in terms of the bond market, making yields go lower, and then potentially the impact on the dollar? Or is this just sort of going to be an event that the bond market, for whatever reason, chooses to ignore, and maybe it focuses on more, the perceived important things like the inflation data that's coming out this week? That's why this week is fascinating on so many levels. You've seen the bounce in crude oil. That makes sense. Will you see a follow through? I think the real play to look at is gold, and then subsequently, when the bond market reopens, what happens to rates?
Yeah, Liz, to that point. So the bond market is closed today for Indigenous Peoples Day. So we don't see what the 10-year or whatever, any of the treasuries are doing. The TLT is up about 1%. That would assume that bonds are down. So to Guy's point about a flight to quality, so buying U.S. treasuries and pushing yields lower. How are you thinking about this? Again, we have to go through this. All of us were sitting there and watching this unfold over the course of the weekend, and it's just heartbreaking from a humanitarian level. But then you're going to get back to the thing that we're here to do is try to help people navigate these sorts of situations. What were some of the most important kind of takeaways that you had as you're thinking about being a market strategist? Where do you want to focus here?
Well, first of all, a sad weekend, sad start to the week. And yes, my heart goes out to everybody over there and everybody that's dealing with this. What I'll say about events like this, first of all, people like us talk about geopolitical risks all the time. We talk about the possibility of black swan events. The definition of a black swan event is the thing we don't see coming, right? We've been talking about on this podcast and on other programs for a while now that China is the big possibility black swan, right? But that doesn't really qualify because we've been talking about it. So here we are in a situation where we have an event that nobody saw coming. And I'll tell you this, things like this are never just what they seem at first blush. So you sit there and you think about over the weekend, which is what I was doing Saturday afternoon, Saturday night, thinking, okay, what are the logical first reactions in the market? The logical first reaction is oil. We're having that right now where you've got perhaps more supply constraint than we've already had. Not a great environment for that to be happening in because we've already seen such volatility and such a rise in oil prices, which, as we know, puts more strain on the economy, more strain on consumers, and just more question marks about inflation. So we're seeing the tremors in the oil market right now. But even if you think about what happened when Russia invaded Ukraine, we all knew that there would be backlash from the oil trade and all of the things that went on between Russia and Europe. What we didn't think about, at least personally, what I didn't think about in those first few days was how much wheat we got from Ukraine, right? And the way it was going to affect other commodity prices. So I think we should expect this week and next week there to be knock-on effects, fallout that we didn't see coming, that we didn't think about at first. And then the bigger risk, in my opinion, geopolitically and to markets, is that how many other countries, how many other regions get involved in this? Does it spread? Does it stay contained? And then that becomes a much bigger question mark at a time when we're all worried about global recession. We're worried about inflation being an issue. And now you've got costs that perhaps increase in many different regions for defense, for aid, not helping the inflation story at all.
So, and that's a great point, Guy. When Liz talks about it from a fiscal standpoint, I mean, we would not have had all of this inflation, right, if we hadn't seen some of the fiscal response to the pandemic. And if you think about, some of that being diverted towards, just the making of ammunition or the making of, a whole host of other, uses for war, it does kind of speak to an environment where maybe there's less support. But by that token, with commodities, bid up like this, if we were to see sustained sort of war in the Middle East and other countries were drawn into it, that's obviously inflationary at a time when we're really trying very quickly. And that's the beauty of this book, Chip War, really talking about, chips as a source of national security, right? So you have this move away from China, diversifying away from some potential conflict with Taiwan. It's all really inflationary at a time without that fiscal support. It could be a low growth environment. And then we find ourselves, I mean, it's crazy to think about. We find ourselves in a period not too different, Guy, than the 70s, where we first had a spell of stagflation, which took decades, I think, to kind of get past.
Things move faster now, but you're exactly right. And we've talked about the different parallels between what's going on now and the different times throughout our history. And you're right to mention, the inflationary pressures this creates, which you wonder, does it almost render the numbers we're going to get this week somewhat moot in the sort of understanding that all that's in the rearview mirror, and now there are a new set of circumstances that we start to have to deal with? And how does this impact the Fed? And there's so many fascinating things in terms of our world to take a look at. You're right to point out commodities. Again, I think where I stand on the commodity front. This does nothing to help or assuage any of the concerns on the sort of supply side of things. And we'll see how it plays out. The market, I don't know, the U.S. equity market under pressure, but historically, things like this actually sometimes counterintuitively provide a bit of a catalyst. So I don't know what to make of it in terms of the markets. I mean, certain things make sense. The gold move makes sense. If you see quasi strength in the dollar, I guess that would make sense. We'll see in the bond market, but the equity market's going to tell the tale. And we'll talk about some of the indicators there. You know how I feel about the equity market. I'm bolstered by the fact that we sort of held that 4,200 level like a champ, and it obviously bounced on Friday. But we'll see if that was sort of, short-term pain for longer-term, or short-term gain for longer-term pain.
Yeah, and your point, about about wars and what they kind of mean for economies, what they mean for markets. If you think about, March of 2003, when we moved into Iraq, that was basically the bottom of a 3-year bear market, right? The market was down in 00, 01, 02. We were actually headed for almost new lows in early 03, and it literally, the bear market ended on like a dime. Now, no one knew at the time that was the case here. But I think it was obviously a very different situation. If you think about the period that we're in right now, we actually haven't even had a recession yet. I mean, that's a big part of it. And I just think it was interesting last week, there are a couple prominent strategists other than you out there, EY.
There are others?
There are others, believe it or not. There was Michael Hartnett of Bank of America said he is not convinced the bear market has unfinished business. Marko Kolanovic over at JP Morgan also said we could see the potential for a 20% plunge. Guy, he was on CNBC's Fast Money with you. I mean, to Guy's point, when we think about that test of 4,200 in the S&P 500, Liz, I mean, it really did stop exactly where it was supposed to do. We know that 200-day moving average is right in around there. That was the breakout level from June or so. What do you think? Is this likely to put more recessionary fears back on the table, especially if we get higher readings in PPI and CPI this week?
Well, first of all, as a strategist, among others who are very well respected, when somebody like Marko Kolanovic says something that dramatic, you got to listen up. And he knows how much power he carries. When he comes out and says something like that so publicly, I think he really means it. And I think it's a genuine concern of his. The drawdown that we've seen since the end of July has been pretty chill, frankly. It's been pretty orderly. It hasn't been the result of some big catalyst, some huge event that occurred and sends people in extremes. It wasn't this precipitous decline, everybody rushing for the exit at the same time.
It was the rate move, don't you think?
Which is rational. Yeah. In my opinion, the market had been irrational about rates for a while, right? You got stocks up, rates up. That didn't make much sense. So as rates rose and the speed with which they rose, valuations did need to come down, but that valuation give back was pretty orderly. So you didn't see the market go to extremes, and you didn't see this sort of building, selling begets selling sort of behavior. And I think that's part of why it bounced off 4,200. There wasn't this extreme level of fear. Yes, we had a bunch of the bulls switch over to be bearish, right? And the sentiment in the market changed. Certainly momentum changed. You saw some of those near-term indicators change momentum. But there wasn't a catalyst that said, everybody run, rush, get out. This is a crisis. So I can't say that I'm super surprised that it bounced off of 4,200.
It was orderly. Right. It did what it needed to do.
Right. And so the technicals held up.
Yeah.
Right. And I'm not saying they're going to stay holding up. There probably will be some sort of catalyst. Maybe this is part of it. Or maybe it's earnings. Maybe it's disappointing earnings season. Maybe there's a corporate announcement. I know we've been talking about that for a while. I think there needs to be more of a catalyst if we want to see the technicals break down and for things to really bust through those support levels, because at this point, the buyers still have a reason to buy.
Yeah. So Guy, Charlie Bolello had some data in his weekly. We'll put it in the show notes here. Only 8% of stocks in the S&P 500 closed above its 50-day moving average last Tuesday, October 3rd, which was the most extreme oversold level since October of 2022. And he put some data in there. What happens when stocks are extremely oversold? They tend to bounce with above average forward returns. 1 month up 3.5%, 3 months up nearly 4%, 6 months up 8.4%. And then on the flip side, Guy, we were talking about, expectations for Fed rate hikes at the November 1st meeting. Okay. So I think about a week and a half ago, that might have been about 30%. Looking at the CME Fed Watch tool, they've been cut in half since then. So I think a lot of that work has been done in the last couple of days. Put those two things together, oversold readings in equities because of that precipitous rise in rates over the last, call it, month or so. And now expectations for a rate hike getting cut in half to less than, let's call it, 20% because what? Because I don't know, equities did their job a little bit. I don't know, Guy.
Well, it's interesting. I rarely, if ever, hear people talk about overbought conditions. I'm sure it comes up from time to time, but you don't really hear it all that often because obviously it's in everybody's best interest for stocks to go higher. So if in fact statistically that were the case, people, I guess, or it's not their want to point it out. But obviously if things are overbought, things can be oversold as well. I'm hard pressed to fully understand. I mean, I understand the data that he brings forth and the number of stocks closing below and all those different things. And we have had a decent move to the downside, but it's not like we've seen this dramatic move. It certainly hasn't been a panic move. So I don't really understand how, you can put this oversold conditions. Now I'll say this as well. The market could go sideways to slightly higher for a course of time and work off those oversold conditions rather quickly. We've seen that before as well. So there are many reasons to be bullish or bearish, and this could be a potential catalyst, but this in a vacuum, Dan, doesn't do a whole lot for me. And that's just my opinion. All respect to his work, but I think you understand what I'm saying. It's not like we've seen some cascade lower over the course of a couple of days. It's a pretty orderly move since effectively late July, early August.
Yeah, and so this week, I think earnings get kicked off. It's going to tell us a lot. I mean, when you think about sentiment and you think about just kind of where the market has been in 2023 relative to the fact that earnings have actually been declining, they haven't gotten as low as many folks thought at late last year where S&P earnings were going to be, Liz. But this is from our main man, Butters, over there at FactSet. He is a senior earnings insight analyst. S&P 500 expected to see the fourth straight quarter of earnings decline here. So when you think about that, and I think that, we have the expected decline for Q3 of 0.3%. This would be the fourth straight quarter over quarter, year over year earnings decline for the index. We've had the earnings recession. We haven't had the economic recession. If you look at expectations for 2024 earnings expected to be up double digits, is that if we have higher for longer rates, we have a dollar, let's just say that even just firms, the US dollar index in and around this kind of 105, 106 sort of level, we have higher commodity prices. Are we likely, and people are going to really start to get focused on 2025 earnings, are we likely to see 12% or more raise next year after we've had 4 consecutive declines this year?
I think that would be very aspirational to see double-digit earnings growth. I think we should be happy with 5% earnings growth in an environment where we've got capital constraints, we've got figuring out whether or not companies can make it through this environment, we've got margins compressing, we've got a consumer slowing down. I would be happy with low single digits, mid single digits. I think 12% is highly aspirational. One of the things I want to go back to too, this oversold thing, this is one of those periods, and I think earnings fall into this category too. You can find the data to support whatever your take is. And whatever somebody's calling oversold on one side is going to be different on the other, right? One of the measures that you use a lot is RSI, the Relative Strength Index. That touched 30, which would be oversold on the S&P, but it's back up to 43 now. So never really got below 30, never really got to a condition where we would call it oversold from a strength perspective. And to Guy's point, and to the one that I talked about earlier, it was a pretty orderly decline. You don't usually find yourself in a slow, kind of boring oversold condition. You find yourself in a surprising oversold condition after a big shock where things fall very quickly. So I don't think that we got to oversold levels. We never even got to correction territory. So I don't think we got oversold. Earnings could be something that takes us to a more decidedly oversold condition if we start to get news from companies, and this could be the quarter that we start to get it. If we start to get news from companies that 2024 is not going to be as good as we thought, if we start to get news that they need to cut costs, I think I've mentioned this on one of these programs before. I asked somebody who I respect immensely what their expectation was for earnings in 2024. They responded something along the lines of margins are going to keep expanding. And I said, how can that be? The math of that would suggest that you must be expecting companies to cut costs. And they said, yes, I do expect them to cut costs, and in the form of labor. So it was a, yes, margins will expand, but because of cost cutting, because of things that we are going to probably start hearing about.
Which is crazy because of that hot data that we saw on the jobs front on Friday. So that's crazy. All right, let's segue to earnings, because individual earnings, that is, because Tuesday before the open, we have Pepsi. And this is a stock guy that was making new all-time highs, okay? early this year, I think late last year, early this year, now trades at a market multiple after a 20% plunge, okay, from those recent highs, which is pretty astounding. For the first time, trading in a market multiple, I mean, to me, like, I just find this really fascinating, Guy. We haven't had earnings cuts in this company yet, right? But is it a rates thing? You know, we've talked about consumer staples and the whole group has absolutely gotten killed. And I just wonder, when we think about who are reporting this week, we have a couple airlines, we have some staples, and we have banks. All three of these groups have acted horribly. And when you talk about sentiment, and you talk about into earnings events, I mean, it couldn't be worse for these groups right now. So if the news is not great, but not worse than expected, or not worse than, let's say, a 20% plunge that we've seen in the jets, which is the airlines. We've seen banks 20% from their highs. Now we're seeing staples. I mean, that's kind of crash territory. That's not correction territory, Guy.
No, it's interesting. So this stock, to your point, Dan, I didn't trade 200, but it got damn close in the spring. I think in May it got up to 196 and change. And here we are, either side of 160, levels that we last saw, oddly enough, this time last year. So it's not like we haven't been here before. So here we are. Let's try to figure out why that's happening. Part of the reason, I think, is because Pepsi can no longer really pass their cost onto their consumer. You know, we've talked about that for a while. That organic growth that the Pepsis and the Cokes, Kellogg's of the world talk about is really code for we're just passing on our costs to the consumer. That's no longer the case. One, there's also this sort of phenomenon going around, and a lot of people are talking about it, as the United States specifically becomes more health conscious in the form of a myriad of different things. It's obviously hurting names like Pepsi and Coke. That's a smaller part of it, but it's out there as well. The really question is, at what point does this thing become attractive on valuation? You talked about it trading at a market multiple, but broader, what does it really mean? You know, what are we seeing when you have basically, you know, Teflon companies, staple companies, lower left to upper right for years on years have a move of this magnitude in a short period of time? I think that's speaking to something in terms of A, the consumer, but B, maybe the market as well.
All right, but here's one for you, Guy, really quickly, because for years, people have talked about Apple and its expanding multiple, right, over the last 5 years. And you've made this point, when it was a growth stock, it traded like a value stock. Now that it's got mid-single digits earnings and sales growth and flat margins, it trades like a consumer staple and trades at 27, 28 times. So if Pepsi and Coke can come in 20% and go from a high 20s multiple to a market multiple in and around 20 or so, couldn't Apple do the same thing, Guy?
Absolutely. And I'm sure Elizabeth has thoughts on this as well. But, you know, I think, listen, Carter talks about this. I don't know if he coined the phrase, but the generals are the last to go typically in the market. And obviously Apple is one of those generals. And it's been this place, this flight to quality or flight to perceived quality in the form of Apple. I think to a certain extent, the market seems to think that higher rates don't really affect Apple as much given their balance sheet. But again, they're making things that people want to buy. Let's not kid ourselves here. You know, you can talk about the innovation and all those things, but it comes down to the simple fact that they need the consumer to buy things, to buy their products. And if that is slowing, which is manifesting itself, by the way, over the last 3 quarters, at a certain point, I think the market starts to take that into consideration.
There's a phrase that's used in baseball, a lot of sports. It's called utility player, right? And it's used for the person that can play a bunch of different positions and be pretty good at a bunch of different positions, which is hard in baseball. Usually if you're a catcher, you're not good at other things, so on and so forth. These stocks, Apple as an example, some of these really big mega cap tech stocks, many investors have regarded as the utility player of the market, in the sense of when things are good, we call them high growth stocks and they should be doing well. When things are bad, we call them defensive stocks and they should be doing well. When things are going sideways, they should do okay, because where else are you going to put your money? When rates are rising, they should do fine. When rates are falling, they should do fine. That is not typically how the market works. There are not a lot of things out there that are going to work in every single environment. And I'm not saying that there needs to be a reckoning that comes for these mega cap tech stocks or some of these big behemoths that we've relied on in every environment. But at some point, if fear hits the market, defensives, in my opinion, regular defensive, straightforward stuff, the boring stuff, the stuff that everybody believes is dead, I think will work again. And it's not ever that different, right? Things do change. The weightings in the market change. but it's not ever completely different.
It is interesting. Guy alluded to this, like the Ozempic effect, these GLP-1s, these weight loss drugs, that is a little wrinkle that we're not going to be able to quantify for salty and sweet snacks and sugary water and that sort of thing. So it's interesting. That, I think, added a little bit of fuel to the fire. Another group, Guy, and we'll just focus on banks here. On Friday before the opening, we're going to have JP Morgan, we're going to have Citibank, we're going to have Wells Fargo, PNC. JP Morgan and Citi are likely to have very different results. But Jamie Dimon has been pretty negative over the last few weeks, right? His stock has shown really good relative to performance to Bank of America and to Citigroup. But when I look at this BKX and I look at the fact that about a year and change ago, or early 2022 was making new all-time highs. You look at the lows that were made during the regional banking crisis. You look at the bounce and how much is given back. I am hard pressed in this environment, Guy, when we know that some of these big money center banks have very similar held to maturity, mark-to-market issues with their treasury holdings and the like, that we are not going to see some significant losses as there is greater demand for deposits and keeping those deposits where they are. So you tell me, whatever, sentiment is into bank earnings, maybe you get a pop like we did after Q2 earnings, but many of these banks have made new lows and really underperformed the S&P. So I'm curious, thoughts on the banks here, because I'm not telling you I think they're a good press into earnings, but if they bounce hard after, they're probably a good sale at that point, because I am hard pressed to see that the BKX does not go in round trip to those 2020 lows in March.
Which I think, if I'm not mistaken, was around 72 and change back in, I want to say May, but whatever. All those things sort of cascaded lower on the back of Silicon Valley. BKX now trading 75.5. By the way, it rallied all the way up to, I think, 89 or maybe even 90 in the middle of July. Just keep that in context. Bank of America, as we're sitting here making multi-year lows, I happen to agree with you. I don't know if they're a press here. I don't even know if you necessarily trade them, but you have to watch them in terms of the context it gives you for what's going on. In the absence of bad news, a lot of these small and regional banks rallied after Silicon Valley Bank. That made sense because on valuations, a lot of those stocks got throttled. They've all started to come back since, as I mentioned, late July, and in a very methodical way to the downside. I think that is telling a story. And you say what you want. JP Morgan, I think they've navigated this rate move extraordinarily well. Kudos to them. But you mentioned Jamie Dimon being negative for quite some time now. And I think I hate picking on Bank of America, but I sort of have to here because it's a relatively large bank trading particularly poorly for quite some time now. There's something clearly going on there. And if the banks are telling a story, the banks are the lifeblood of our economy, regardless of what you may think. They might have the same value in terms of their percentage of the S&P 500, but in terms of what they mean for the U.S. economy and the consumer, they mean a great deal.
You got to respect a guy like Jamie Dimon who comes out and almost purposely doesn't talk his book, right? He leads one of the biggest banks in the world and has been negative on the economy. Marko Kolanovic, obviously from JP Morgan as well. You have to respect the authenticity of those takes. And obviously, both of them have a vested interest in the financial sector doing well, but the reality is that they don't see good prospects for the economy coming up. And the financials, it's a risk we know. So this is something that, as an investor, sometimes it can be a contrarian signal. If things get low enough, they get sold and nobody wants it. You want to, somebody else's trash is your treasure. What you pick the phrase. But financials at this point, the big banks included, I think it's played out that they have benefited from regional banks. They've benefited from the stress that's happened in regionals. We know what the stress is in regionals. We know what the possible catalyst and the issue could be for them. And we also know about commercial real estate that still hasn't really blown up, right? But we know that there are a lot of embedded risks there. So financials are the risk, and as an investor, it's something that as we try to figure out how we're getting from late cycle back to early cycle, it's not a place that I would be piling a bunch of money in and seeing this as a contrarian signal. I think that this is probably more of a coincident signal for the economy and everybody worried about some sort of credit stress or event coming up.
Yeah, which has been pushed out. It seems to be, listen, Guy had this really good point last week. Carter on Market Call was I think he was charting the micro cap sector, the Russell, micro caps, and just looking at the absolute and the relative performance. It's just really bad. And when you think about, who those companies are and what percentage, small cap or small medium businesses make of employment, despite what we saw on Friday out of that September jobs report, and to some of the things that you were just saying about cost cutting, it really feels like, the unemployment rate is going to start to tick up in a way that will not be conducive. At least, if companies can't pass through those inflationary pressures, at some point you're going to see a hit to margins, and that should be the thing that maybe takes the stock market down a little bit. And maybe that's what's going on in staples right now. Okay, again, so people, we appreciate, we like to usually have a little fun on a Monday morning, and it just doesn't feel a whole heck of a lot of fun out there right now. So our hearts go out to everybody who's being affected by the situation over there. We hope there's a speedy result, but we're going to keep kind of doing what we do and figure out ways to kind of think about markets, think about the economy, think about how you're investing in and around a really difficult situation. But also stick around for this conversation. Guy and I had a great talk with Chris Miller. He's the Associate Professor of International History at the Fletcher School at Tufts University. He's the author of Chip War, The Fight for the World's Most Critical Technology. And you know the drill. Go to OK Computer, follow it in the podcast store, leave a review, take a screenshot, send it to Amanda at contact@riskreversal.com, and you are going to get a copy of Chris Miller's fine book. So stick around for that conversation. Thanks, Liz. Thanks, Guy, for being with us here this Monday morning.